Now, the next concept is basically a prerequisite knowledge that you are supposed to carry from the FM paper. And it is not specifically mentioned as a separate concept in AFM, but I did see a couple of questions on this in the exam kit. So I thought a small 5-minute video on this concept would do the trick. This is the shape of the yield curve. Now, you know what is yield, right? Interest yield. Yield means how much am I getting after investing. Say, for example, the face value of a bond is 100 rupees. It has a coupon rate of 10%, but the market price is 80. What does that mean? I'm investing 80 and I'm getting a return of 10. So on the amount of investment, which is 80, how much return am I getting? I'm getting a return of 10, that is 10 upon 80, which is 12.5% return. Now, this is not the coupon rate, but this is the actual return that I have earned on one particular 80 rupees that I have invested in the stock market. Now, this is yield, right? And we have studied this in the past. But what we are discussing right now is something known as the normal yield curve. Now, what is this yield curve? This yield curve basically has the term to maturity on the x-axis and the gross redemption yield or the interest yield on the y-axis. If you observe, as the number of years are going ahead, as the term to maturity is going ahead, we also see that the gross redemption yield is increasing. But if you observe carefully, this isn't like a straight line. No, it isn't. It's an upward sloping curve. It's not a straight line, which means there isn't a strict linear relationship between the term to maturity and the gross redemption yield. But yes, as the term to maturity increases, so does the gross redemption yield. Now, the normal yield curve under normal circumstances is an upward sloping curve, which means that where the term of maturity increases, the gross redemption yield also increases. Now, there are three reasons why there is a direct relationship between term to maturity and gross redemption yield. Now, think about a situation where, say, for example, I ask you, can you give me 10,000 rupees? I'll return it to you within 2 days. You'll be like, okay. And if I ask you how much interest do I need to pay, you'll be like, come on, it's okay. Why will I charge you interest for 2 days? You might not charge me anything. If I say, can you give it to me for 2 weeks? You might charge a little interest. If I say, can you give it 10,000 to me for 2 months? Okay, now you might charge me, say, 4% interest because you are staying away from your money for longer. I will take 2 weeks to return your money. And what if I ask you, can you give this 10,000 to me for 10 years? Don't you think you would be a little more insecure by this point in time? And rightfully so, because now you are going to stay away from your money for a longer period of time. Hence, you require a higher compensation for the amount that you have lent to me. So, the idea in behind the upward sloping yield curve basically stems from this. Investors have a natural preference for more liquid investments. They will need to be compensated if they are deprived of cash for a longer period. What does that mean? That means if the longer I stay away from my money, the higher compensation I would expect. So if I have lent money to you for a longer period of time, I would expect a higher rate of interest as compensation from you. The second part is the expectations theory. The normal upward sloping yield curve reflects the expectation that inflation levels and therefore interest rates will increase in the future. The law of rising prices, and you expect the interest rate to increase in line with the increase in the rate of inflation. Now, over a long term planning horizon, you only expect that the inflation rates will go up. I mean, history has shown us that as time goes ahead, the prices of commodities become more and more expensive. And to finance the purchase of those commodities, there would be more borrowing. And if there is more borrowing, the interest rate would be higher. So that is the second reason behind why the normal yield curve is an upward sloping curve. And the third part is the market segmentation theory. The third reason, the market segmentation theory suggests that there are different players in the short term end of the market and the long term end. So people who invest in the short term end of the market, short term participants, are basically the money market participants, and they part with their money for a shorter duration of up to 1 year, and hence their expectation of interest is lower. Whereas people who play in the long term market, they part with their money for a longer duration, and hence their expectation of return is also different. Now, this market segmentation theory can very easily be tied up with the liquidity preference theory also, which is why the normal yield curve is an upward sloping curve, and because there is a direct relationship between the term to maturity and the gross redemption yield. Financial managers should inspect the shape of the yield curve when deciding on the terms of borrowing or deposit, since the curve encapsulates the market's expectation of future movement in interest rates. Graphically, if this particular plotting is done on the graph in a scientific manner after considering the multiple factors which have an impact on interest rates, you will observe that as the term to maturity increases, so does the gross redemption yield.